If you look at risk from one dimension, you might be missing the big picture. Long-term bond funds with high-quality bonds sound pretty low risk, and in fact, many have little credit risk. However, some people have said long-term Treasury ETFs are low risk because the federal government is a very low credit risk. But these funds carry a lot of interest rate risk. Treasuries pay lower dividends than other debt of similar maturities because of their low credit risk, but that actually means they have more interest rate risk because their lower yields provide less to make up for declines in principal. There are a couple ways to understand this risk. First, check a fund's duration. That's a measure of how much interest rate risk a fund has. The whole bond market has a duration slightly under 6 years right now. So any duration figure above 6 years suggests a fair amount of interest rate risk. Vanguard Long-Term Bond Index has a very low credit risk rating of AA- for its portfolio, but a huge duration of 13.7 tells you it's actually riskier than most bond funds. The other way to get a handle on interest rate risk is simply to go over calendar year returns with a particular focus on 2022 when interest rates popped higher. That same Vanguard fund lost 27% in 2022. iShares 20-plus years Treasury Bond ETF ticker TLT lost 31.4% in 2022, and Vanguard Extended Duration ETF EDV dropped more than 39%. So no, I don't think these funds are low risk. Most investors don't really need a fund like these, as generally we want bond funds to serve as ballast for equities. However, you can use these funds effectively if you have your eyes open to the downside. If you have a bond portfolio that is heavy on the short end, you could use funds like these to provide a little extra exposure to the longer end of the yield curve. But I would still limit them to maybe 2% of my portfolio, so that a year like 2022 won't torpedo your whole portfolio.